2024 and beyond to a neutral rate of 2.4%, which is lower than the Fed had been projecting in the past. The Fed, in its comments, saying, with appropriate firming in the stance of monetary policy, the committee expects inflation to return to the 2% objective and the labor market to remain strong. In support of these goals, the committee decided to raise the target range for the federal funds rate to 0.25% to 0.5% and anticipate ongoing increases. The target range will be appropriate. They go on to say, in addition, the committee expects to begin reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities at a coming meeting. Now, that's the only reference to the balance sheet. No details on what their plans are or when they're going to tell us about them. They do mention the invasion of Ukraine by Russia, saying that is causing tremendous human and economic hardship. The implications for the U.S. economy are highly uncertain, but in the near term, the invasion and related events are likely to create additional upward pressure on inflation and weigh on economic activity. Speaking of economic activity, they're expecting the United States economy to grow at a much slower pace than they were back in December when they thought we would see 4% growth this year. Now that's been marked down to 2.8%, 2.2% in 2023, and 2024, 2%. Those are basically the same numbers we saw in December. Unemployment, 3.5% this year, next year, and 3.6% in 2024. So they don't seem to be thinking their rate increases are going to raise unemployment. Inflation, PCE inflation was 2.6% for 2022 in the December forecast. It's now 4.3%, dropping to 2.7% next year and 2.3% in 2024. And as we mentioned, the long run rate for the Fed funds is going to be 2.4%. So 2.4 would be neutral for them. There is one dissent today, guys, and that is St. Louis Fed President Jim Bullard. He thinks the Fed should have gone 50 basis points. It's a 9-1 vote.
You're working through that, Tom, still?
I look at this Mike McKee, and we're looking, folks, at 40 and 50 headlines that Mike McKee goes through with great preparation. And, Mike, I am absolutely thunderstruck that they wander back to 5% nominal GDP 2 years out. How do they propose that occurs? Inflation disappears?
That would seem to be the argument that the survey of economic projections, the summary of economic projections makes, because at this point they're seeing growth at about where it was before the invasion and before the oil prices started to shoot up, whereas inflation is going to go up significantly and then drop by more than 2 percentage points by 2024.
Going to go through this price action, Mike. We fade on the equity market on the S&P, up 8 or 0.9%, on the NASDAQ, up by 1.7. Looking at the bond market, yields up at the front end on twos. Can we get to that and just look at treasuries? What a move, up 9 basis points to 193.79, pushing 220 now on 10s, up by 4 or 5 basis points. This was never about the 25 basis point pop. It wasn't even about the descent from Jim Bullard looking for 50. It is all about that dot plot. Mike, to see 22 go to about 1.9%, then 2.8% for 23. Think about where this dot plot was just 2-3 months ago.
And you have 5 members of the Open Market Committee saying we could be over 3% in 2023. So there is some disagreement over how far they're going to have to go to bring the inflation genie back to the bottle, let alone stuff it back inside.
This is a big change, Bramo, a big change for this Fed, finally catching up. I have to say, out of all the...
So just to jump in, guys, so we've got a 0.25% rate hike, but the summary of economic projections is also going to be important. How did people vote? Because they don't just vote for what rate hike do they see now, but they vote for what they want to project going forward as well as GDP growth. So we can see currently that Bitcoin is falling on the news, as obviously the economy is not doing as well as people had thought, and they're kind of getting a reality check that, look, the interest rate has fallen. But it'd be good to hear what Jerome Powell says in his statements. We'll be listening out for the words he uses during his statement.
So it's the narrowest since 2018.
Well, they're telling you that they're going to have to be restrictive at this point, which is a fairly hawkish statement for them to make with all the uncertainty still out there. Because the neutral rate, they're saying, is 2.4%. So they're going more than a 0.25 percentage point above that. And that would really put the brakes on the economy if you think that 2.4% is a legitimate neutral rate. You have people like Larry Summers saying it might have to be 5%.
John, I just did the 2-year yield you've been highlighting, and I did it with a log y-axis, which shows rate of change, and the rate of change now is extraordinary. John, it is stunning how the 2-year yield is back to late 2018-ish when you look at the rate of change.
On January 26th, Tom, this 2-year yield closed at 115. That was when the Fed last met. We're now pushing 2% on a 2-year yield.
I mean, I was doing the math there, folks, with this pause, and that's what we do. And we do that with great conversation with great guests. Scott Miner joins us right now, Guggenheim Global Chief Investment, and he has built a career on the first derivative. Does the Fed have control, Scott Miner, of the rate of change, the first derivative of these market movements?
Tom, I think it's pretty clear they don't. And, it's...
Whilst they're having a chat, guys, let's have a quick read of the statement, which was released exactly at 2 p.m. Eastern Time. Indicators of economic activity and employment have continued to strengthen. Job gains have been strong in recent months, and the unemployment rate has declined substantially. Inflation remains elevated, reflecting supply and demand imbalances related to the pandemic, high energy prices, and broad price pressures. The invasion of Ukraine by Russia is causing tremendous human and economic hardship. The implications for the US economy are highly uncertain, but in the near term, the invasion and related events are likely to create additional upward pressure on inflation and weigh on economic activity. We're aware of that. It's not out of the norm. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the long run. With appropriate firming in the stance on monetary policy, the committee expects inflation to return to its 2% objective and the labor market to remain strong. In support of these goals, the committee decided to raise target rate for the Fed funds rate to 0.25% and anticipates that ongoing increases in the target range will be appropriate. So it's exactly as expected, guys. Nothing came out crazier than we thought. The market's going to do what the market's going to do, but eventually it'll settle down and say, hang on a second, we've got our 0.2% interest rate. We're going to see a couple more. We're going to see these regularly now, at least 7 in a row probably. And the only time the market has a real reason to start worrying is if we see a double rate hike, right? Or anything like that, which is more aggressive or hawkish. Let's continue reading here. In assessing the appropriate stance on monetary policy, the committee will continue to monitor implications of incoming information for the economic outlook. The committee will be prepared to adjust the stance on monetary policy as appropriate if risks emerge that would impede the attainment of the committee's goal. Let's just make sure we're not missing anything here. Nope. So, okay, let's keep going. Voting for the monetary policy were, we know the members. Voting against this action was James Bullard, who preferred this meeting to raise the target by 0.5. Remember, we spoke about Bullard before. He's a hawk. Now, normally in the Fed, you'll have a couple of hawks, you'll have a couple of doves, and you have somebody in the middle, and they vote. That's the whole purpose of the Fed meeting. So it's very normal for a few people to want to see a 0.5% rate hike, but we didn't get that, okay? The Board of Governors of the Federal Reserve voted unanimously to raise the interest rate on reserve balances to 0.4. As part of its policy decision, the FOMC voted to authorize and direct the open market desk at the Federal Reserve. Fine, effective March 17th. Fine, this is all the technicals, which we don't need to know about. Now we just need to go and wait to see what Jerome Powell says.
The market's telling you the terminal rate for the have to do. Greenspan will try to balance the risks between financial markets, the economy, and inflation, and be a maestro. And I think he will attempt to be a maestro.
All right. So how do you be a maestro? How do you have a Fed put at a time when, frankly, exactly the turmoil that you're seeing in markets is part of the only tool that the Fed has to dampen inflation?
Right. Well, Lisa, look, inflation is always and everywhere a monetary phenomenon. That's the words of Milton Friedman. And what we need to do is control the money supply, control the balance sheet. And, as we've been talking today, with that is not the mindset of the Fed. The Fed thinks it can control interest rates. And so somehow it's going to manage its way through. So, I think that the Fed has largely abandoned monetary orthodoxy. It's trying to be too cute in how it's managing this. And ultimately, if we just would stop growing the money supply, just as we experienced in the 1940s, inflation dropped from 20% to deflation within 2 years by just not.
Nobody worry about what's going on in the charts, okay? This is normal trader activity, which we expect. This stuff can happen. It's not an issue. Traders are obviously waiting to play these kind of events. Long-term holders shouldn't be concerned about short-term price
The biggest
actions.
consequence will be, what do you think?
We need to wait to see how does it settle over the next 24 to 36 hours. That's what's key.
Okay.
I think that they will look at a period of a series of folly in terms of Fed activity. That is that they probably overreacted to the pandemic. They pumped too much liquidity in the system, and then when faced with a surge in inflation, that they hit the panic button and that they tried to reverse course too quickly and ultimately create some sort of a financial accident.
Scott Miner, thank you so much. John, we got to reset here with the move. John, I'm going to talk about the 2-10 spread. It is absolutely crushed. The focus is on short-term yields, John. I think it speaks volumes that 2-10 spread is gapping down near 20 basis points.
Just going through the bond market on the screen, Tom, we can go through this maturity to maturity. 2s, 3s, 5s, 7s, 10s. We're up 11 basis points on 2s. On 10s, we're up only 6. So the difference between the two narrows, the curve flatter, 25 basis points. The difference between 5s and 10s,
wow, look at that.
less than a basis point.
On radio, I really got to state this out for the folks that we've seen curve steepening over the last number of days. John, I have never seen this swing that we see of 12 basis points, 0.12% movement off of the 2-year versus 2 basis points on a longer piece of 3-year bond.
So the Y, Tom, the Y is in the dot plot. We've taken the median dot to 1.9% for 2022. In 23, we've taken it to 2.8%. So this was always a 3-part story. 1, you got the Fed decision up 25 basis points. 2, you got the forecast, just talking about them now, including the dot plot. 3,
right.
You get the emphasis in the news conference. The news conference, Tom, 17 minutes away.
All of a sudden, really interesting to see what's going to happen here. Diane Swank joins to brief now with Grant Thorpe.
Let's see if we can go through this as well, guys, together. So these are the projections, summary of economic projections, also known as SEP. This is what also moves the markets as well. Okay, guys, so important that we flick through this. We don't need the opening page. Here we go. This is what we need to look at. So change in real GDP. So the median vote was that they see GDP as 2.8. They see 2.2 in 2023, and then 2.0 longer run 1.8. Okay, so you can see how the ranges vary. So they're saying 2.1 to 3.3, which is interesting. Let's keep going. They see inflation, core inflation. Well, let's do unemployment rate. Unemployment rate they're seeing at 3.5. They see it pretty much staying there for the next 2 to 3 years, and longer run back to 4% unemployment rate. Core inflation they're seeing at 4.1, 2.6, and then come down to 2.3. So that's the consensus. Let's see if we can get the dot plot. There we go. So this is your dot plot. So in 2022, you can see this is where they see the different rate hikes. This is where they vote. So each Fed member will put a dot where they think the interest rate should be hiked by each increment. So by 2022, you can see the different rate hikes, and you can see they do that all the way up until the longer run. So eventually you can see us settling in. Mainly the majority of the dots are saying, we should be here after let's say use 2024, we're in the range of 2 to 3%. Okay, you can see that's pretty much where the majority land, and that's interesting for what we'd expect, right? We expect to at least get to 2% quite soonish. We'd expect 7 to 8 0.25% hikes, which will get you to about 2%, and then we'll have to reevaluate what they're planning to do from there. Okay, so that's your dot plot. won't flick through all the rest, but if any of you want to look for this, just type in summary of economic projections.
Higher unemployment.
This is the issue. And Dan, you've touched on it, and I want to keep calm about it. Let's go through the forecasts. December projection for growth, 4% for 22. They've cut that to 2.8%. For unemployment, 3.5, 3.5. Hasn't moved. PCE inflation has gone from 2.6% to 4.3. So Dan, we saw this at the ECB. You raise the inflation forecast, the Fed's done that. You drop the GDP forecast, the Fed's done that. And then I look at unemployment, just going through this now. 2022, 3.5%. 2023, 3.5%. 2024, 3.6%. Can they get rates anywhere near 3% in 2023 without their unemployment forecast changing from 22 to 23? Diane, that doesn't make sense, does it?
It doesn't. And in fact, I mean, the scenarios that I've run, even with oil prices sort of holding 95 for a little bit, 98, that still gets us to a stall out at best in the second half of the year with growth of 1% in the second half.
Right, let's get back over to Bitcoin and see what are we seeing here. Let's go over to the hourly. Obviously, the minute chart, you're going to see a whole bunch of trader activity. But on the hourly, it's not too bad, right? You had a run-in. Right now, a lot of people are saying, oh, what's going on? Why are we falling to the downside? Well, what happened was you've seen there was a massive run-up, all of the last 2 days here. We've kind of had a big run-up from lows of 37,500 up to 41 on this wick, right? So you've had that, and you're going to get a little bit of a cooling off now, just as that, realization hits that interest rates are going up, the economy is overheating, we're going to be in a long period of interest rate hikes. I mean, ultimately, let's think about what's going on, guys. We've had an unprecedented amount of printing, an unprecedented amount of Red Bull in the economy, right? That's been pushed into the economy. The market's bound to be upset for a little bit, but it'll get used to it. They realize, hang on a second, I've stopped drinking Red Bull, things are okay. And then another rate hike of 0.25. Oh, you like that? Okay, another 0.25. And eventually we'll get back to 1.75. We'll get to 2%. And we'll realize, hang on, the economy is doing pretty well. Nothing to moan and cry about, okay? So generally, this is looking pretty fine for the day. No issues really here on the charts. We just need to see how this plays out over the next few days. That's going to be key, is how do the markets take this in? Let's also take a look at the S&P, because remember, it's the S&P that's going to decide if we're risk on and risk off. Bitcoin is just copying the wider market right now, okay? So it's looking to see if we're risk on, risk off. And the S&P is looking good. We're getting a good rally. We've come from, we've had a pretty good day here. Let me just show you on the daily chart. You can kind of see this is a good jump up from the lows. I mean, from the lows where we were at 410, now sitting at the S&P at 428. You can't complain. That's a good move to the upside. I mean, if you wanted a crazy rally, you would need no interest rate hike, right? But for the fact that we've just come off stimulus, we've stopped the printing, and now we're putting the brakes on, this is okay. And the market's going to come to terms with this over a little bit of time.
If the Fed is to see the economy slow, we're going to see financial assets come under pressure. The only solution the Fed has historically is to dump liquidity into the system, which puts us right back into the stagflation story. So I think this is all fantasy land, and I don't. The one thing I think that is interesting here, and I think Diane will agree with me, I'd love to hear it, is the higher the rate of inflation, the lower real growth is. So if we're marking inflation up from 2.6 to 4.3, by definition, that brings real growth down, because the economy, will only grow at a certain nominal rate. But I mean, Diane, I'd love to hear your comment.
All right, Diane, since that is the question, what's your take?
Yeah, actually, my forecast is weaker than that for the year, and I have a similar inflation forecast, actually maybe a little higher than the Fed's, but I think that's important, is that the numbers don't add up, and this idea that, and they even put it in their statement that they're doing this to prolong the health of the economy. That is true, that we need to get rid of inflation, but
let's look at how we're doing back on the charts. And you guys remember, if you've not watched my videos from yesterday, I do cover off that I took a risky bet. I started buying what I thought would be, it felt like a bit of peak FUD. Now, like as I said in the video, I was prepared for 10, 15% more downside. So it's not like I went all in. I just nibbled some more, bought some more, because when I feel peak FUD, when I see the markets panic and being historical, that's where I put my money where my mouth is, and I pick some more up, and I let you guys know that in the video. So now we can see Bitcoin is starting to tread the right way. The fact that it's holding up here just a couple of, $100, $200 away from 40,000 is a good sign. We just need to get to 40,000 and break through it. So we need a bit of a catalyst on this side to help us move through here. Let's see how the wider markets are doing on CNBC. So obviously we've got our first rate hike. Well done, CNBC. We can see European markets are doing fine, very buoyant, and US markets are doing all right. They're holding its gain. NASDAQ, more importantly, is up 1%. Now, remember, I'm pretty bullish on risk on right now. I think the risk on market has been so battered that I can see an opportunity for risk on stocks such as your Tesla, your high-tech companies, those in the NASDAQ, and then obviously Bitcoin falls into that category as well, as having an opportunity to start moving to the upside. So I'm really waiting to see how the market takes this in its stride and how they, once they digest the news, where do we start to head to? Because this could really be the start for a rally for us. And I think the key levels for us, just coming on over to the hourly chart, obviously we know we're in a key wedge here on Bitcoin, is we got to get past 40,000 and hold above it first. So you can see we're getting this bit of a retest. Can we get that retest, bounce up, and then head towards 41,659? And then we've got to take it level by level at a time on the technical charts, okay? Now, remember, we said we were going to get a whole volatility leading up to this meeting. Now we're waiting for direction. Now that doesn't stand what I said before, okay? Remember, I did say that we were going to have a lot of false starts and a lot of volatility, and that's exactly how I think it's played out. Now what I'm expecting is we're moving in one direction or the other. We got to start either falling down to this wedge, or we need to start moving up towards 44.5 and breaking to the top side of this wedge. And if we do, that's when we start to look at targets such as 52,000 on the breakout of this wedge, but there's a lot of work to do in this wedge first, okay? So again, just to recap, 40,000, got to get that level, 41,659, then work towards our levels at 43 around here, but then the critical one is at the top of the wedge at 44.5. We need to push through that level and get to that level at the top here, okay, before we break out and start working towards 52. But the good news is finally we can start to say, okay, we've not got any more excuses to wait for things. The only excuse really waiting now is the Ukraine and Russia war, which is a fair one, but that is something that can, throw the market off at any given time. But if we can keep that to the side and say, okay, we know there's an ongoing war, but the rest of the market and the economy and the projections of the economy show that we're in a strong economy, and we're moving onwards. The interest rate hike is there. We're going to get multiple interest rate hikes. Can we absorb that? Can we crack on? And can we have some directionality now to start moving to the upside? Remember, markets don't like uncertainty. That's all it is. Once they know, that's all they care about. They just need to know what's going on. If you're heading to the downside, let the investors know so they can prepare accordingly. If it's heading to the upside, let us know accordingly. They just don't like not being in the know. That's why markets are tense leading up to announcements such as the one we've just had from the FOMC.
Percent. Do we know the x-axis on that? I don't think we have a clue what the timeline is at one time. My biggest problem with this, Diane, I'm thinking this is like Michigan economics. We don't know the x-axis.
No, and that's this. The Fed doesn't know either. They have a high level of uncertainty. Balance sheet going to amplify the effects of these rate hikes as they widen it down.
I want to take the economics here. Swan can go over to the markets and the finance of minor. Scott, if that's the case and the x-axis is a complete mystery, ranges have gone wider because of Ukraine. We get that. How do you trade? What's short term? Is the new long term 5 years?
Well, Tom, I always make a joke that I think the definition of the long run is we're all dead, but the reality, I say, from an investment standpoint, most people think of 5 years as the long run, and so I think that the decision you have to make as an investor today is,
right,
are you looking at the long run, or are you going to be trying to?
And by the way, guys, this. The signal we saw from the dot plot of seeing another 6 rate hikes, which gets us to about 1.5 and then 1.75, that's completely, that's expected. That's perfectly fine. And in fact, I'd even go to say we could see up to 17 rate hikes going forward over the next couple of years. Okay, guys. So the first 6, I think he's just kind of letting the market know that's the first 6. You're going to get it. We've got to get back to 1.5 at least, and then we'll reevaluate it from there. I don't think the markets will be too fussed by this. I'll be very surprised if the markets aren't able to take this in their stride over the next few weeks.
Basically, or rather 0 basis points, I should say. That means that 7-year yields are that much higher than 10-year yields because of the expectation of a slowdown.
5s, 10s, only a basis point separating them now. Guys, the news conference starts in about 5 minutes. Diane, you're always great at this. If you had a question for Chairman Powell, let's start right there. What would it be?
Well, it really would be.
Stay tuned, guys. We're going to cover off the whole press conference from Jerome Powell. I've got a killer headache. I literally just drove up 6 hours to my next meeting. Literally just ran straight through into the hotel room and turned the live stream on. So yeah, I hope you guys appreciate that. Smash up the likes, and we'll make sure we stay tuned for the whole Jerome Powell press conference. What we're listening out for really when Jerome Powell speaks is, does he have dovish tonalities, or is he pretty hawkish? If he keeps it nice and neutral, the market's going to be fine. If he keeps it dovish, good for the market, and you'll see the market slightly rally as he speaks. If he says things like, coming in a bit more hawkish and aggressive, saying the economy is really healthy, we got plenty of room to increase interest rates, it doesn't matter what's going on with the war, we're going to crack on and increase aggressively, then you get my point, right? The market is going to fall. Now, I think he's going to come in a little bit vague, a little bit ambiguous, a little bit in the center. His statement, which we just read, was fairly bullish, right? It was fairly dovish. It wasn't too aggressive, but he was very clear that the market is healthy. He's reiterating that message, just like his previous meetings, that the market is healthy and it's the right time to see these interest rate hikes. So let's see how he backs it up in a couple of minutes on the live press conference. Let's take a quick look at Bitcoin before he comes on. Bitcoin sitting at 49,749. You've got Ethereum sitting at 2,656. You've got Phantom, our friend here, sitting at 115. Phantom doing pretty well. It's kind of created its little bottom here. You can see it's created its mini low at $1.03. I was lucky enough to buy in at $1.04, $1.05. And this is why we got to be patient enough to buy on the pullbacks, buy on the dips. Practice managing our psychology. That's what this is all about. I know it's not fun, but that's what it's all about. You've got Solana running a little bit. So as we're seeing, normal course of action where Bitcoin's moving slightly, and we see some of our favorite altcoins moving as well. So definitely something to keep an eye on. But right now, it's like I keep saying to you guys, it's a bit silly to keep looking at altcoins, looking at certain chart patterns. We've got to look at the longer term, what's going on in the economy, because we know Bitcoin being treated as a risk-on asset. I've said it time and time again. Therefore, we just need to see what the wider economy is doing. That's why on a crypto channel, we're having to show you guys and teach you guys macroeconomics and the interest rate impact on Bitcoin, because not a lot of channels are talking about it, right? Where are those channels now? The ones which we know about, where are those now? Because all they're saying is, it's a head and shoulders pattern. Can they talk intelligibly about what's going on with the economy and how that's affecting it? Because we need to understand this. If we're long-term investors, this is really, really important for us. Because if we're betting on markets over the next 3, 4, 5 years to move to a certain direction, we need to understand what are the major things impacting it. We've had 3 years of stimulus. We're now going into an environment, 2 to 3 years of raising rates. We need to understand what that means. We need to position our portfolios accordingly. Blue collar mindset, that 2-year and 10-year spread getting closer and closer, and the US dollar is getting stronger. All bad news for crypto, unfortunately, looking like a recession may be on the horizon. Yeah, all the indicators are indicating a recession, but we've got to wait and see. I'm a bit 50-50 on this one. Yes, the indicators are showing us that we could be heading in that direction, but it's also an unprecedented time. You can't really compare what's happened to any other previous recession. So all these indicators are right until they're not. And that's why I'm always wary when people pull up charts and say, the last 5 times this happened on the chart, this is what happened next, right? We've got to be very careful with that, because this is an unknown time. We've not had 3 years of unprecedented stimulus where so much US dollars were printed. On top of that, you've got a potential World War III scenario on top, impacting inflation on top. But weirdly, you've still got a healthy economy with good employment. It's really bizarre, really odd. And even for somebody who's been in the markets for a fairly decent time, obviously I'm not the oldest, let's go straight to Jerome Powell, guys. Jerome Powell starting, I believe.
Market through the end of this year.
Now, it's one thing forecasting, Gear. It's quite another
Come on, guys, go to Jerome Powell.
Pushback we'll get from the market in the coming weeks and months, and you wonder how much that will constrain this Federal Reserve with inflation still pushing 8%. Going into this news conference, markets look like this. We fade on the S&P 500 big time. On the S&P up more than 0.1%. We were up about 1% going into the decision. The NASDAQ up 0.8%. The NASDAQ fades as well. Into the bond market, just ahead of Chairman Powell. Yields on twos, they are at 197.50. Here is the Chairman of the Federal Reserve.
Good afternoon. I want to begin by acknowledging the tremendous hardship the Ukrainian people are suffering as a result of Russia's invasion. The human toll is tragic. The financial and economic implications for the global economy and the U.S. economy are highly uncertain. At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Today, in support of these goals, the FOMC raised its policy interest rate by 1/4 percentage point. The economy is very strong, and against the backdrop of an extremely tight labor market and high inflation, the committee anticipates that ongoing increases in the target range for the federal funds rate will be appropriate. In addition, we expect to begin reducing the size of our balance sheet at a coming meeting. Economic activity expanded at a robust 5.5% pace last year, reflecting progress on vaccinations and the reopening of the economy, fiscal and monetary policy support, and the healthy financial positions of households and businesses. The rapid spread of the Omicron variant led to some slowing in economic activity early this year, but cases have declined sharply since mid-January, and the slowdown seems to have been mild and brief. Although the invasion of Ukraine and related events represent a downside risk to the outlook for economic activity, FOMC participants continue to foresee solid growth. As shown in our summary of economic projections, the median projection for real GDP growth stands at 2.8% this year, 2.2% next year, and 2% in 2024. The labor market has continued to strengthen and is extremely tight. Over the first 2 months of the year, employment rose by more than 1 million jobs. In February, the unemployment rate hit a post-pandemic low of 3.8%, a bit below the median of committee participants' estimates of its longer-run normal level. The improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, and while labor force participation has increased somewhat, labor supply remains subdued. As a result, employers are having difficulties filling job openings, and wages are rising at their fastest pace in many years. FOMC participants expect the labor market to remain strong, with the median projection for the unemployment rate declining to 3.5% by the end of this year and remaining near that level thereafter. Inflation remains well above our longer-run goal of 2%. Aggregate demand is strong, and bottlenecks and supply constraints are limiting how quickly production can respond. These supply disruptions have been larger and longer lasting than anticipated, exacerbated by waves of the virus here and abroad, and price pressures have spread to a broader range of goods and services. Additionally, higher energy prices are driving up overall inflation. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine will put additional upward pressure on near-term inflation here at home. We understand that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We know that the best thing we can do to support a strong labor market is to promote a long expansion, and that is only possible in an environment of price stability. As we emphasize in our policy statement, with appropriate firming in the stance of monetary policy, we expect inflation to return to 2% while the labor market remains strong. That said, inflation is likely to take longer to return to our price stability goal than previously expected. The median inflation projection of FOMC participants is 4.3% this year and falls to 2.7% next year and 2.3% in 2024. This trajectory is notably higher than projected in December, and participants continue to see risks as weighted to the upside. The Fed's monetary policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people. Our policy has been adapting to the evolving economic environment, and it will continue to do so. As I noted, the committee raised the target range for the federal funds rate by 1/4 percentage point and anticipates that ongoing increases in the target range will be appropriate. The median projection for the appropriate level of the federal funds rate is 1.9% at the end of this year, a full percentage point higher than projected in December. Over the following 2 years, the median projection is 2.8%, somewhat higher than the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. Reducing the size of our balance sheet will also play an important role in firming the stance of monetary policy. At our meeting that wrapped up today, the committee made good progress on a plan for reducing our securities holdings, and we expect to announce the beginning of balance sheet reduction at a coming meeting. In making decisions about interest rates and the balance sheet, we will be mindful of the broader context in markets and in the economy, and we will use our tools to support financial and macroeconomic stability. As we noted in our policy statement, the implications of Russia's invasion of Ukraine for the U.S. economy are highly uncertain. In addition to the direct effects from higher global oil and commodity prices, the invasion and related events may restrain economic activity abroad and further disrupt supply chains, which would create spillovers to the U.S. economy through trade and other channels. The volatility in financial markets, particularly if sustained, could also act to tighten credit conditions and affect the real economy. Making appropriate monetary policy in this environment requires a recognition that the economy often evolves in unexpected ways. We will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain moment. We are attentive to the risks of potential further upward pressure on inflation and inflation expectations. The committee is determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Let's go to
Here we go,
Jeanette, the New York Times.
Hi, Chair Powell. Thank you so much for taking our questions. I wonder if you could detail your thinking a little bit about how you're considering the risks of going too fast and potentially tipping the economy into recession, and how you're weighing those risks against the possibility of going too slowly, allowing inflation to become embedded and kind of getting behind the curve.
So I guess I would start by saying that, in my view, the probability of a recession within the next year is not particularly elevated. And why do I say that? Aggregate demand is currently strong, and most forecasters expect it to remain so. If you look at the labor market, also very strong. Conditions are tight, and payroll job growth is continuing at very high levels. Household and business balance sheets are strong. And so all signs are that this is a strong economy, indeed one that will be able to flourish, not to say withstand, but certainly flourish as well in the face of less accommodative monetary policy. So I guess that's how I would say I'm looking at that. Of course, the objective is to achieve price stability while also sustaining a strong labor market.
There we go, guys.
That is our overall objective, but we do feel the economy is very strong and well positioned to withstand tighter monetary policy.
Thank you. Let's go to Howard at Reuters.
Hi, Chair Powell. I was wondering, in the steps, you have quite a markdown to GDP from 4 to 2.8%. I'm wondering, how much of that do you feel is the result of the Fed's stiffer than expected action here? You talk about monetary policy operating with a lag, but is this going to bite quicker than expected?
I don't think that's a big piece of it, actually. I think some of that is just an early assessment of the effects of spillovers from the war in Eastern Europe. which will hit our economy through a number of channels, highly uncertain, but you're looking at higher oil prices, higher commodity prices. It'll be so that we think that will weigh on GP to some extent. So that's part of what moved those assessments down. I think generally monetary policy works with a lag, so some of that would also be in there. But remember as well that 2.8% is still very strong growth. If we think that the potential growth rate of the economy is somewhere around 1.75%, 2.8% is strong economic growth. It would have been one of the strongest years, in fact, of the last expansion. So while it's lower than last year's 5.8%, it's still quite strong growth. So I would say it's quite a strong forecast.
So in that context, what would trigger you to go faster or slower on the rate hikes? Ongoing increases doesn't really tell us whether this is going to come in bigger chunks or evenly paced through the year.
Yes.
Yeah, so the way we're thinking about this is that every meeting is a live meeting, and we're going to be looking at evolving conditions. And if we do conclude that it would be appropriate to move more quickly to remove accommodation, then we'll do so. I can't be perfectly specific about it, but that's certainly a possibility as we go through the year.
Thank you.
Thank you. Let's go to Rachel at the Washington Post.
Very coy on that one, as expected.
Thank you, Michelle, and thank you, Chair Powell, for taking our questions. I'm curious if you can be specific on when you expect to see inflation will start to come down, especially with the combination of rates going up, fiscal aid dissipating from the economy, and supply chains getting better. And if you don't start to see that, how will you signal it? What will you be looking for, and what will you be looking for over the course of the year? Thank you.
So I guess I would say that before the invasion of Ukraine by Russia, so let's go back to that. I would have said that the expectation was that inflation would peak sometime in the first quarter, maybe the end of the first quarter of this year, and then maybe stay at that level or a little bit lower, and then start to come down in the back half of the year. So now we're already seeing a little bit of short-term upward pressure in inflation due to higher oil prices, not natural gas a little bit, but not so much for us since we have our own natural gas supply, other commodities prices. The other thing is that you're seeing supply chain issues around shipping and around, lots of countries and companies and people not wanting to touch Russian goods. So that's going to be more tangled supply chains. So that could actually push out the relief we were expecting on supply chains generally. So I guess I would say that the expectation is still that inflation will begin to come down in the second half of the year. But if you look at where I read the SEP headline median, we still expect inflation to be high this year, lower than last year. And then we expect, though, particularly with the effects of the war, but also the data we've seen so far this year, we expect inflation to remain high through the middle of the year, begin to come down, and then come down more sharply next year.
Let's go to Nick at the Wall Street Journal.
Nick Timmeros of the Wall Street Journal. Chair Powell, over the last 6 months, the Fed has shifted its policy stance quite a bit. 6 months ago, you were still buying assets. Most officials weren't projecting any interest rate increases this year. And yet, despite the shift over the last 6 months, real rates are as negative today as they were then. So how concerned are you that further inflation surprises will offset the effects of recent policy firming by leading real rates to stay at levels that do not actually provide much restraint to the economy? Thanks.
So that's one of many ways of capturing the situation, which is that the committee really does understand that the time for rate increases and for shrinking the balance sheet has come. And I would just say, I would go back to the economy is very strong. As I mentioned, tremendous momentum in the labor market. We expect growth to continue. It's clearly time to raise interest rates and begin the balance sheet shrinkage. And I just wanted to say that as I looked around the table at today's meeting, I saw a committee that's acutely aware of the need to return the economy to price stability and determined to use our tools to do exactly that. you couched it in terms of real rates. I would say if you look at the SEP, you've got people getting close to or even above, in many cases, their estimate of the longer run neutral rate. So I understand that doesn't do it for real rates, but if you go out a year or two, many people are in their forecasts are having tight policy from a real interest rate standpoint. So that's something that we're focused on. Of course, it's a highly uncertain environment, and we don't know what's going to happen, but we do know that we're going to deploy our tools to achieve our goals, and that includes the price stability goal.
Let's go to Victoria at Politico.
Hi, Chair Powell. So looking at the summary of economic projections, you all have inflation coming down over the course of the year to 4.3%. And then you also have rates going up to what appears to still be below roughly what would be estimated to be the neutral rate, although I know that's a little bit uncertain. So I was just wondering, how much of inflation coming down do you see as actually being as a result of the Fed itself raising rates? And then also, if I could just ask, given that Sarah Bloom Raskin withdrew her nomination, what do you expect to do with the regulatory portfolio? Do you expect to assign a governor in charge of that?
Okay. So sorry, tell me again your first question.
My first question is, how much do you expect inflation to come down as a direct result of the Fed's actions?
Okay, so part of inflation coming down at the very beginning is clearly to do with factors other than our policy, and those would include potentially the supply chains getting a little bit better. Certainly base effects, you're lapping, as you know, when you look at a 12-month trailing window, you're lapping very high inflation in March, April, May, June of last year. So there should be some effects from that in the 12-month picture. Really what we're looking for, though, is month-by-month inflation coming down. And so it's really it's all the things we've been talking about, that really haven't helped much, including the shift away from goods and back to services, including supply chains getting better, including labor force participation, all those things that have been sticky and not happening. But a big part of it is the base effects I mentioned as well. I think monetary policy starts to bite on inflation and on growth with a lag, of course. And so you would see that more in 23 and 24. But also remember, we started talking about rate increases last year. For some months now, the financial conditions have already incorporated a significant number of rate increases. So it doesn't start today. In effect, the moves are already priced into the market for a few months now. So the clock is running on that, and I think some of that will be seen in the second half of the year as well. And on the regulatory portfolio, I would just say this: we have an obligation to carry out under the law in supervision and regulation, and we're doing that. That's what we're doing. The committee is not active, so what's happening is things are coming to the full board, and we're voting on them. We're getting our business done. We got the stress tests done. We've looked at a number of proposals for mergers and things like that. So we're working ahead. Of course, we don't have a vice chair for supervision, as you mentioned, but we're making do with the situation we have, and a good number of things have come straight to the board for approval.
Go to Neil Irwin at Axios. Let's go to Neil Irwin.
Hi, Chair Powell. It's Neil Irwin at Axios. Thanks for taking our questions. In the statement of economic projections, we see a forecast of median 1.9% Fed fund rate at the end of the year, 2.8 end of next year. Wondered whether that aligns with your own expectations, in particular on that point of overshooting the long-term neutral rate. And also, if you can tell us anything about how that might be paced, front-loaded, back-loaded, how high is the bar for doing 50 at one meeting?
So I don't, Neil, I've never talked about my own SCP projection. It's in there, but I think Fed chairs have generally not done that because we just haven't done it. It's because we have to put together the consensus on the committee and present that consensus. So I wouldn't talk about my individual one. And in terms of the pacing of it, I would just point out that there's 7 remaining meetings this year. This isn't something we discuss or debate or agree on, but there's 7 remaining meetings and there's 7 rate hikes. I would add, there's also the shrinkage of the balance sheet, which people do the math different ways, but that might be the equivalent of another rate increase just from the runoff of the balance sheet. So I don't know. We haven't made any decisions on front end loading or going steadily through the year. And as I mentioned, if you look at the S&P, a good number of participants do see more than 7 rate increases this year. And I can't give you, I'm not going to try to give you a really specific test for what it would take to do that. But I will say this, though, we'll be looking at the data as they come in. We'll be looking to see whether the data show expected improvement on inflation. We'll be looking at the inflation outlook and making a judgment. And we'll be going, each meeting is a live meeting. And if we conclude that it would be appropriate to raise interest rates more quickly, then we'll do so.
Are they done? Any more questions for Jerome Powell? That's not me who's lost audio, that's them. Get your stuff together, CNBC. Literally, they're frozen CNBC, it's not me. There we go.
I think we might have some audio problems with Chairman Powell, as far as I'm aware.
Yes,
Tom, we haven't got that feed right now. It seems to drop out. It looks like the chairman can actually hear some questions that he's been asked, though, at the moment, TK. So unclear what's happening on the Fed side
Try one more time.
at the moment. Looks like they've got some audio problems on their side, Tom.
Yeah, we'll have to see. We'll monitor that.
Let's leave them to that, and we'll see Bitcoin try to, as he was speaking. We did actually run above 40,000, just coming back below. It's just hugging its comfort point, right? The 40,000 mark is Bitcoin's comfort area. It's hugging it, and it's good. We're far way from the levels of 32, 33. It's a comfortable spot for Bitcoin, and you guys should be comfortable as well. If you held through 32, if you held before that at 29 like I did, going back to July last year, these are just comfortable levels, right? You can see a 10, 15% fall from here, and you're comfortable, right? Things shouldn't be too spooked out here. The key is just stay calm, guys. Right now, we're in an environment now where we're going to see interest rates start to go up. Just stay calm, follow your high conviction, dollar cost average, buy on pullbacks. It's not rocket science. Just people don't want to be patient. They want to trade when they're not traders. I have a trading background. I worked in investment bank trading, and I still opt out of trading many times because it's very, very difficult. If you're not part of an institution, if you're not part of a hedge fund or an investment bank, there's odds are against you to win this game. You're playing a sport where you don't know the rules. And that is why they continually wipe out retail traders. So unless you've got experience, stay away from that. Keep it simple. Just trade. Let's see if they've managed to bring him back.
Off the balance sheet. We will take the necessary steps to ensure that high inflation does not become entrenched while also supporting a strong labor market. And as I mentioned, if we conclude that it would be appropriate to move more quickly, we'll do so. I leave it to others to make the judgment you ask for.
And then just as a follow on that, I wanted to get you on the record on this. What impact has there been on your job, given the fact that you...
Again, CNBC? You gotta be kidding me, man.
Lost you in the middle of the question.
Just tell us what you're going to do then. I'll ask you one. Just give us the next 2 years worth of rate hikes listed out.
That question?
I don't know why they're pretending. They've got the questions written down. They can give it to him.
Given you're not actually confirmed and Governor Brainerd is not actually confirmed, has there been any impact on your job or the Fed's ability to handle inflation?
None whatsoever.
He's rough.
Okay, let's go to Colby Smith at the FT.
Thank you, Michelle. Chair Powell, how concerned is the committee about the notable pickup in services inflation, which is perhaps less likely to self-correct? And to what extent does it alter both the committee's confidence that long-term inflation expectations will not de-anchor in the coming months, as well as the balance of risks that the Fed may need to raise interest rates further above neutral than indicated in the dot plot? Thank you.
Thank you. So, of course, that's something we're watching report by report, and we noticed it in the last meeting, and it's part of the overall picture. We have expected services inflation to move back up to where it was, and that's part of what's happening. Is in the case of some services, prices are still getting back up to where they were before the crisis. In other cases, it's pretty clear that inflation has spread more broadly across services, and yes, that is concerning. In the meanwhile, we see some progress on the goods side, but really in this latest report, it was confined to vehicles, which is admittedly a large category. So, as I mentioned, the committee acutely feels its obligation to move to make sure that we restore price stability, and is determined to use its tools to do so.
Thank you. Let's go to Steve Leisman at CNBC.
Thank you, Mr. Chairman. I wonder if you could help me understand the kind of logic, if there is one, inside the SCP here. As I look at the median forecast, for example, for unemployment, it runs for the 3-year window below the long run rate. I look at inflation.
Oh, man.
The long run, or call it the neutral rate, so the economy still runs hot. And that is all true in a regime when you run, at least for 2 years, the funds rate above the long run rate. I guess my question is this: are you not give a forecast here that essentially suggests you will be continuing to run further behind the curve and never really get in front of inflation because the economy will continue to run hot? And kind of on a related issue, you said earlier, inflation will take longer to return to price stability than we had originally expected. Isn't that a choice you're making? And if so, why are you making that choice to let inflation run above price stability longer than you'd like?
Right. So if you look, first of all, you're looking at medians, but understand that it's not something we voted on. It's not a plan. But if you look, people do have their by the end of this year, broadly, people are at or close to, or in some cases above, their estimates of longer run neutral interest rate. Okay, so that should stop pushing. That should, in other words, that should be a removal of accommodation for monetary policy, basically. At the same time, we will have done significant balance sheet runoff, and you can think of that as further. In the next year, and just looking at the median, you're now above the what people estimate to be the longer run median. So and also in many people's forecasts, that actually amounts to tight policy in real rates as well. So why does unemployment remain at 3.5%? A couple points. One is the connection between in the economy we had before the pandemic, the connection between inflation and the level of the unemployment rate was not very tight. But this is clearly what this is an expectation that really it amounts to the idea that wage increases, which are now running above the level that would be consistent over the long run with 2% inflation, will move back down to levels which are still very attractive, full economy kind of full employment kind of wages, but not to a point where they're pushing up inflation anymore. And as I mentioned, there are a lot of factors causing inflation to come down. And the reality is there are many moving pieces, and we don't know what will actually happen. But no matter what happens, this is a committee that is determined to use its tools to make sure that higher inflation does not become entrenched. And so we are determined on that front, and we'll deal with what comes. This is a modal or most likely expectation, but we'll deal with what comes, whether it's better or worse.
Thank you. Let's go to Chris Rugaber at the AP.
Hi, thank you. Well, let me follow up a bit on that. I mean, there are a lot of economists skeptical that you can reduce inflation as much as you've penciled in without raising the unemployment rate. And I'm wondering just what are the mechanisms you see in reducing demand? I mean, outside housing and autos, how do higher Fed rates reduce consumer demand unless it's through higher unemployment? Thank you.
Well, if you take a look at today's labor market, what you have is 1.7 plus job openings for every unemployed person. every unemployed person. So that's a very, very tight labor market, tight to an unhealthy level, I would say. So in principle, if let's say that.
Guys, so far so good. Powell is not rug pulling the market. This is good, right? He's not being too hawkish. He's not going to panic the market. Bitcoin's holding up fairly well. It's kissing 40,000. S&P looking stable. Nasdaq looking stable. This is good so far. So far so good.
Like 1-to-1.
Just don't say anything which is going to mess this up, Powell. Don't mess it up for us.
On wages, you would have a lot less of a labor shortage, which is going on pretty much across the economy. We're hearing from companies that they can't hire enough people. They're having a hard time hiring. So that's really the thinking there. Is these are fairly well understood channels, interest sensitive, and basically across the economy, we'd like to slow demand so that it's better aligned with supply, give supply at the same time to recover, and get into a better alignment of supply and demand, and that over time should bring inflation down. And I'll say again, though, we don't have a perfect crystal ball about the future, and we're prepared to use our tools as needed to restore price stability. With as I mentioned in my opening remarks, without price stability, you really can't have a sustained period of maximum employment. It's one of our most fundamental obligations is to maintain and restore, in this case, price stability. So we're very committed to that. Of course, the plan is to restore price stability while also sustaining a strong labor market. That is our intention, and we believe we can do that. But we have to restore price stability.
Okay, let's go to Scott Horsley at NPR.
The sooner this ends, the better, because you may say something which will mess it up.
I apologize if this covers some of the same ground you just talked about, Mr. Chairman. I think I missed some of your answer there, but I have a follow-up question on the labor force. We have seen some gains in the prime age workforce in the last few months. I wonder what you anticipate when it comes to some of the older workers as the health outlook has changed. Are we going to see more recent retirees following Tom Brady back in the workforce? And what would that mean for wages and inflation?
It's hard to say. What we saw in the last cycle was that over the course of a long, steady expansion, labor force participation outperformed expectations, and that was just it was a tight labor market, but it was nowhere near as tight as this labor market, but it was a tight labor market, and so people stayed in the labor force longer. It wasn't so much people coming back in the labor force after retirement. That's not something that happens in the aggregate very much, but. So that's what was happening. And, more labor force participation is tremendously welcome. And of course, our policy does not in any way preclude that. This is a situation where wages have moved up at the highest rate in a very long time. And people are able to quit their jobs and move to better paying jobs in the same industry or different industry. So it's a really attractive labor market for people. And once, as we get past COVID, well and truly, it becomes an even more attractive one. So we hope that will lead to more labor supply. That's a good thing for the country. It's a good thing for people, and it also will, we think, help relieve some of the wage pressures that do put inflation more at risk. That last part is we'll have to see whether empirically it works out that way. But in principle, it ought to help with inflation as well. It's not the only thing we're looking for, though, from inflation. We're looking for help from a number of different places, and most importantly, from our own policy.
Okay, let's go to Rich Miller at Bloomberg.
Thank you, Michelle, and thank you, Chair Powell. I'm sorry, I'm having some communication problems, so I've missed some of the stuff you've said. My apologies if this has been asked. Since the FOMC met last January, financial conditions have tightened markedly. Equity prices down, treasury yields up, bond spreads risen, yield curve has flattened a lot, and even further this today, dollars up. Is that welcome? And would you like to see more in order to achieve your goals? Thank you.
As you know, policy works through financial conditions. That's how it reaches the real economy, by just the mechanisms you mentioned. And remember that the financial conditions we had for the last couple of years were a function not only of very aggressive and appropriately so fiscal policy, but also highly accommodative monetary policy. The monetary policy settings that we put in place at the worst parts of the pandemic. So it is very appropriate to move away from those. And yes, that will lead to some tightening in financial conditions in the form of higher interest rates and just the sorts of things. We're not targeting any one or more of those things, but financial conditions generally should move to a more normal level so that because we know the economy no longer needs or wants these very highly accommodative this stance, which, and so it's time to move to a more normal setting of financial conditions. And we do that by moving monetary policy itself to more normal levels.
When you say move to a more normal setting for financial conditions, that suggests to me that you want financial conditions to tighten further from where we are now. Am I drawing the right inference from that?
Well, yes. So I would say we look at a broad range of financial conditions. And of course, when we tighten monetary policy, we do expect that they will adjust in sync over time with monetary policy. It's not any particular financial condition, but a broad range of financial conditions. They will reflect, to some extent, they reflect any number of things. But yes, we need our policy to transmit to the real economy, and it does so through financial conditions, which means as we tighten policy or remove accommodation so that it's at least less accommodative, that broader financial conditions will also be less accommodative.
Thank you. Just a little housekeeping note. Those of you in this call may be having some tech issues. If so, I understand the broadcast is coming through clearly on www.federalreserve.gov. So you might go there for the audio. And now we'll go to Jean Young.
Hi, Chair Powell. I wanted to ask about the balance sheet
Imagine we jumped on the live stream and shouted, "Oh man!"
Can you give us any more details? Did you discuss whether to cap runoffs or whether to increase those caps over what period, if there were any details?
Yes, thank you for asking. So at our meeting today and yesterday, we made excellent progress toward agreeing on the parameters of a plan to shrink the balance sheet. And I'd say we're now in a position to finalize and implement that plan so that we're actually beginning runoff at a coming meeting. And that could come as soon as our next meeting in May. That's not a decision that we've made, but I would say that that's how well our discussions went in the last 2 days. So a couple things just to add. We'll be mindful of the broader financial and economic context when we make the decision on timing. And we always want to use our tools to support macroeconomic and financial stability. We want to avoid adding uncertainty to what's a highly uncertain situation already. So all of that will go into the thinking of the timing around this. In terms of I would say this. I don't want to get too much into the details because we're literally just finalizing them. But the framework is going to look very familiar to people who are familiar with the last time we did this, but it'll be faster than the last time, and of course it's much sooner in a cycle than last time. But it will look familiar to you, and I would also say that there'll be I'm sure there'll be a more detailed discussion of our in the minutes to our meeting that come out in 3 weeks, where I expect that it will lay out pretty much the parameters of what we're looking at, which I think will look quite familiar.
Thank you. Let's go to Michael McKee at Bloomberg TV.
Mr. Chairman, since September of 2020, you've been operating on a monetary policy framework that let the economy run hot to bring unemployment down. That seems to be over, but I'm wondering how you would describe your reaction function now. What is it that the Fed is trying to do other than bring inflation down? In other words, is it we're going to keep raising rates until it comes down to an acceptable level?
Pretty much.
Yeah, so I want to clear one thing up again, and that is that nothing in our new framework or in the changes that we made has caused us to wait longer to raise interest rates. What we said in the framework changes was, and this was really a reflection of what had happened for the preceding couple of decades, actually. What we said was, if we see low unemployment, high employment, but we don't see inflation, then we're not going to raise rates till we actually see inflation. That's what we said. And that was the sense of it. There was no sense in which if we got a burst of really high inflation, we would wait to raise rates. That's simply not in the framework. In fact, quite the contrary. The framework is all about anchoring inflation expectations at 2%. So I do hear this, that the framework, we can't blame the framework. It was a sudden, unexpected burst of inflation, and then it was the reaction to it, and it was what it was. But it was not in any way caused by or related to the framework. So come to today. I think our vision on this on the committee is very, very clear. What we see is a strong labor market. We see a labor market with a lot of momentum, great job creation, and we see the underlying economy strong. Balance sheets are strong. Yes, there are threats to growth from what's going on in Eastern Europe. But nonetheless, in the base case, there's a pretty broad expectation of strong growth. But inflation is far above our target. And, the help we've been expecting and other forecasters have been expecting from supply side improvement, labor force participation, bottlenecks, all those things getting better, it hasn't come. And so we're looking now to using our tools to restore price stability, and we're committed to doing that. And you see that, I think, in the Summary of Economic Projections, and you see that in the decision we make, and you'll continue to see it in the decisions we make going forward.
If I could follow up by asking, I guess what you'd call it is the Paul Volcker question. You don't think unemployment is going to rise significantly, but if it does that temper your desire to keep raising rates?
Well, the goal, of course, is to restore price stability while also sustaining a strong labor market. We have a dual mandate and they're sort of equal. But as I said earlier, price stability is an essential goal. In fact, it's a precondition really for achieving the kind of labor market that we want, which is a strong and sustained labor market. We saw the benefits of a long expansion, a sustained labor market. It pulled people back in, and there were really no imbalances in the economy that threatened the long expansion. The pandemic arrived. It was just a completely exogenous event. So that's how we're thinking about it. We of course want to achieve price stability with a strong labor market, but we do understand also that really you can't have maximum employment for any sustained period without price stability. So we need to focus on price stability, in particularly because the labor market is so strong and the economy is so strong. We feel like the economy can handle tighter monetary policy.
Thank you. Let's go to Brian Chung at Yahoo.
Chairman Powell, hopefully no tech issues here on this front. Wanted to ask just kind of the broad question about how you are communicating what the Fed's doing here today to the average American who might not be reading the dot plots or understanding what the SCP is. How is the 25 basis point hike today and then the signaling on future Fed policy going to address the inflation that they're feeling at the stores on a daily basis?
Sure. So I guess I'd start by just assuring everyone that we're fully committed to bringing inflation back down and also sustaining the economic expansion. We do understand that these higher prices, no matter what the source, have real effects on people's well-being. And really, high inflation takes a toll on everyone, but it's really especially on people who use most of their income to buy essentials like food, housing, and transportation, where, we've all seen charts that show if you're a middle-income person, you've got room to absorb some inflation. If you're at the lower end of the income spectrum, it's very hard because you're spending most of your money already on necessities and the price is going up. So, but it's punishing for everyone. So
you rather increase their mortgage and car payments instead.
But we do anticipate that inflation will move back down, as I mentioned earlier. It may take longer than we like, but I'm confident that we'll use our tools to bring inflation down. And you ask about rates. So the way that works, I would explain, is as we raise interest rates, that should gradually slow down demand for the interest-sensitive parts of the economy. And so what we would see is demand slowing down, but just enough so that it's better matched with supply, and that will bring inflation down over time. That's our plan.
Thank you. Let's go to Jolene Kent at NBC News.
Hi, Chair Powell. Thank you so much for taking my question, doing this today. My question is a follow-up to what Brian just asked. What is your message to consumers out there who can no longer afford the basics due to this high inflation?
Can you just say?
Well, that is, yes, indeed. I mean, as I just said, I think we do understand very much, and we very much take to heart that it's our obligation to restore price stability. And we've had price stability for a very long time, and maybe come to take it for granted. But now we see the pain. I'm old enough to remember what very high inflation was like, and we're strongly committed as a committee to not allow.
Exactly like we said, guys. Red dotted line when the announcement came up. Traders playing games, liquidate a bunch of people, and then boom, off we go. Like, the statement was fine, right? It wasn't super hawkish, and he's been okay so far. But I just want him to stop talking.
I just would want people to understand that, but the way we do that is by raising interest rates and by shrinking our balance sheet, and so financial conditions will become, at the margin, less supportive of various kinds of economic activity. That will slow the economy, while also allowing the labor market to remain very strong. And the good news is the economy and the labor market are quite strong. And that means the economy, we think, can handle interest rate increases.
And as a quick follow-up to that, obviously the Federal Reserve walking this very complicated fine line, trying to avoid a recession. For the consumers out there who are worried about their jobs in a possible recession, what do you say to that?
Well, I say that our intention is to bring inflation back down to 2% while still sustaining a strong labor market, and that the economy is very strong. If you look at where forecasts are, people are forecasting growth that's strong within the context of U.S. potential economic output. And we expect that to continue. And to the extent the data come in different, then of course our policy will adapt. But we do believe that our policy is the appropriate one for this forecast, and we believe that we can bring down inflation. We believe that we can do so while sustaining a strong labor market. The labor market it's not strong in the ordinary sense of the world. We have not seen a labor market where there are 1.7 job openings for every unemployed person, or whether if you add job openings to those who are employed, that's actually substantially a larger number than the size of the workforce, than the number of people who actually count themselves as in the workforce. So this is a situation where demand is higher than supply. And when that happens, prices go up. So we need to use our tools to move supply and demand back. And we don't think we need to do this alone. There will be other factors helping that happen, but we certainly are prepared to use our tools, and we will.
Thank you.
Thank you. Let's go to Simon at The Economist.
Thank you, Michelle. Thank you, Chair Powell. Sorry to take you away from inflation for 1 minute. May I ask about the sanctions on Russia, and specifically the freezing of the central bank assets? Of course, that raises a similar risk for other sovereigns around the world and their biggest companies potentially. Any concerns about, in the long term, how this might affect the dollar's status as the...
So now we've got the S&P and Bitcoin above the levels when the announcement was made.
Kinds of reassurance to other central bankers around the world.
Well, so of course, central bankers around the world are generally very, very in favor of these sanctions. But let me say this: sanctions are really the business of the elected government, and that's true everywhere. So the administration and the Treasury Department in particular, and other agencies, they create these sanctions. We're there to provide technical expertise, but it's not our decisions, so I'm reluctant to comment on sanctions really much because again, they're not for us. We have a very specific mandate, and these are really the province of elected governments, as I mentioned. So I'd have to leave it at that. So, sorry.
Thank you. Let's go to Nancy Marshall-Genzer at Marketplace.
Hi, Chair Powell. Thanks for taking the question. You've been talking a lot about rising wages, which on the one hand is a great thing, but are we possibly seeing the beginning of a wage price spiral?
So the way I would say it is this: we First of all, yeah, I would agree with the premise that wages moving up is a great thing. That's how the standard of living rises over time, and generally it's driven over long periods by rising productivity. But what we have now, if you look at these the wage increases that we have, we look at we're blessed with a range of measures of wages that all measure different things. But right now, they're all showing the same thing, which is that the increases, not the levels, but the increases are running at levels that are well above what would be consistent with 2% inflation, our goal, over time. And that may be, we don't know how persistent that phenomenon will be. It's very hard to say. And that's really, I think, the sense of your question about a wage price spiral is that something that's going to start happening and become entrenched in the system? We don't see that. You can see, for example, in some sectors that got very high wage increases early on, those wage increases look like they may have slowed down to a normal level. But it comes back to, what I'm saying here, which is there's a misalignment of demand and supply, particularly in the labor market, and that is leading to wages moving up at ways they're not consistent with 2% inflation over time. And so we need to use our tools to guide inflation back down to 2%. And that would be in the context of an extraordinarily strong labor market. We think this labor market can handle, as I mentioned, tighter monetary policy. Yeah, and the overall economy can as well. But yes, wages are moving up faster than is consistent with 2% inflation. But it's good to see them moving up. But it wouldn't be sustainable over too long of a period to see them moving up that much higher. And that's because of this misalignment between supply and demand. We expect to get more labor supply. We did last time. We got more than we expected during the last cycle. This time we've gotten much less than expected. So it's not easy to predict these things. But we do expect that we'll get people coming back in the labor market, particularly as COVID.
Powell, you've done your job, man. Just stop. We have to watch to the end just in case he says something.
Something we all wish. So that's how we think about it.
Thank you. And for the last question, we'll go to Don Lee at LA Times.
Hi, Chair Powell. I think you said to the Senate earlier this month that in hindsight, the Fed should have moved earlier. And it sounds like today that you don't think that the Fed is late. And I just wanted to get your clarification on that. And if it is, if you still think that the Fed is behind the curve, how much behind the curve is it?
Right. So we are not. We don't have the luxury of 20/20 hindsight in actually implementing real-time decisions in the world. So, the question is, the right question is, did you make the right decisions based on what you knew at the time? But that's not the question I was answering, which is knowing what you know now. So I think if we knew now, of course, if we knew now that these supply blockages really and the inflation resulting from them in collision with very strong demand, if we knew that was what was going to happen, then in hindsight, yes, it would have been appropriate to move earlier. Obviously, it would be, but again, we don't have that luxury. And then but that's a separate question from your other question, which is behind the curve. And I don't have the luxury of looking at it that way. We have our tools, powerful tools, and the committee is very focused on using them. We're acutely aware of the need to restore price stability while keeping a strong labor market. And what I saw today was a committee that is strongly committed to achieving price stability in particular, and prepared to use our tools to do that. We're not going to let high inflation become entrenched. The costs of that would be too high. And we're not going to wait so long that we have to do that. No one wants to have to really put restrictive monetary policy on in order to get inflation back down. So, frankly, the need is one of getting rates back up to more neutral levels as quickly as we practicably can. and then moving beyond that if that turns out to be appropriate. And as you can see, it is appropriate in a sense to people's SEPs. They do write down levels of interest rates that are above their estimate of the longer run neutral rate. And there's also a range of estimates too, as you will see if you look at the details of the SEP. But thanks for your question.
Okay. Thank you all. Thanks, Mr. Chair.
Thank you.
That wraps up the news
we're
conference
done.
with Chairman Pat.
Good stuff. So there we go. There we have it. Nothing to ruin the market, really. He's not messed much up there. We've got Bitcoin. Now we got to watch what happens, right? Now it's going to be important. We can see we're now higher than the position we were when the announcement was made. That's this red line here when the announcement was made. We initially fell. Traders just playing games, and Jerome Powell's helped the market get to comfortable with what he's done. So let's see now, the next few days. Don't rush into anything. Stay calm. See the course. No need to make any panic decisions. You've got time. The market's not just going to sprint up. It's not just going to sprint down. Be patient. Find your conviction plays and stay the course. Let's take a quick look at the S&P before I head off. And we can see here on the S&P, same pattern. Remember, we're going to follow the S&P, and more importantly, probably the NASDAQ on Bitcoin, because remember, Bitcoin's a growth stock, and you can see the NASDAQ now, from the time when it was announced, we're up here about 0.73% here on the NASDAQ, okay? So that's pretty good move here on the NASDAQ since Jerome Powell started talking. We're getting a good move to the upside. Bitcoin trying to get to 40,500. It's going to be an important level. Let's quickly look here at the daily chart. Remember, we're trying to get this bounce off this wedge. The quicker we can get to 40,000, retest and hold, long term, that's good. We need to get to the top of this wedge and get out of here. That could happen over the next week or so if we see some bullish movements coming into the market, okay? So there you go. What I'm going to do now is I'm going to wrap this up. I'm going to do a summary video for those who weren't able to watch all of this and want to know what Jerome Powell just said. So make sure you hit the like button. Make sure you subscribe, and I'll see you in the next one.